Hello, everyone. Welcome to VRIC Media, your most trusted voice in metals and mining. I'm your host, Darrell Thomas. And before we start with today's interview with Alasdair Macleod, I want to let you know about the New Orleans Investment Conference that is happening from November 2nd to November 5th. I encourage you all to click the link that is pinned in the comments to the conference. They're going to have some amazing speakers such as Rick Rule, George Gammon, Danielle DiMartino Booth, Jim Bianco, many others that are going to be coming and giving their insights on the markets in the economy. So I encourage you to click the link that's pinned in the comments as well as the description to check out the New Orleans Investment Conference. I will be there in person, so if you happen to be there, be sure to come say hello and connect with me. If you're not able to make it in person, there is a virtual option where you can still access this important information, especially at where we are in this cycle. So I encourage you all to check that out, and let's get to the interview. Hello, Alasdair. Glad to be having another talk with you.
Nice to be back. Thank you.
Yes. So we've been talking over the last couple of years, and you've been warning people about what's coming. You know, the how owning gold is a significant is very important for people to understand and understand what is happening on a global shift, on a global scale. And so I want to get your perspective on the recent trade tensions because they had a lot of implications for the markets. I mean, we saw the markets drop significantly. Gold actually, I think it dropped a little bit, then rallied. I just want to get your perspectives there because it seems like stuff is heating up.
Yes, it is. We're really talking geopolitics, I think, in this bit. Bear in mind that in the early days when China embraced capitalism or, markets, if you like, its main export market was America. I mean, they had a massive, massive trade surplus on America, particularly because a lot of American corporations set up their manufacturing businesses in China. So this was American business, just relocated to China. Now, that's gradually declined. And when President Trump took office, that decline actually accelerated. And now, from being such a dominant part of China's exports, America accounts for only about, less than 10%, and it's still declining. So that's the background, if you like. You have President Trump threatening this tariff, that tariff, and all the rest of it, and really being pretty capricious about it. There's no sort of certainty. You can't deal with a man who keeps on changing his mind. So from President Xi's point of view, he doesn't really give a damn anymore. I mean, what's the point? So, it was becoming quite clear that America was just, not playing ball with anything. And in the race for technology, which is actually very, very important, China decided, okay, if we're going to win this race, then we've got to make sure that our competitors don't have rare earths. So she announces restrictions on the export of rare earths. Trump blows his top and says, I'm going to add another 100% tariffs on, And President Xi goes, literally. I mean, the markets, when Trump tacoed, what did Trump all chickens out? When he tacoed, I mean, this has got to be a new word, hasn't it, in the dictionary? What did China do? Did they say, as Trump hoped, oh, thank goodness for that. He's being realistic, he's being sensible. Now we can negotiate. Did they? Hell it's like. They just said, nothing.
It's cold.
Absolutely not. Response. And they're not going to change. They're not going to change their policy, if you like, of starving the West, and particularly America, of rare earths. And I think we can also add silver to that. This is something which nobody's talking about. But China has been controlling the silver market for a long time. It's obviously decided to no longer control it. because control of prices basically means that China has to export silver in order to supply the markets. And we know that there's been a supply deficit of silver for, 5-6 years. Met by what? The Silver Institute sort of says it comes out of investment silver and so on and so forth. Really? I think you'll find that it's actually been, on the margin, it was supplied by China. They've withdrawn from the market. So they're not, they're not in the business of suppressing the silver price in the West anymore. As far as they're concerned, they're going to hang on to their silver. We can go hang.
Yeah, thank you for sharing that. So a couple of things. I do want to talk about the trade dynamics, the relationship with the U.S. and the rest of the world, because I think I remember reading a headline about Xi calling Trump a bully and him not going to cave into those tactics. And I was I thought of this analogy, sometimes you have the schoolyard bully who everyone's afraid of, right? And then you get that one person that challenges the bully, calls him out and pulls his card. And then everyone's looking like, so what are you going to do? Are you going to respond to this call to a fight in the schoolyard? And so it looks like some bluffs are being pulled. I don't know if these tariffs are going to even work. I mean, because China obviously has a lot of leverage in this.
Yeah. Well, it's got the leverage. It's got the leverage of rare earths, which America desperately needs. But they're not going to get it. It's quite simple. It really is. I mean, I think even if Trump backed off and said, "All right, we won't do any tariffs at all," China would say, "Well, yeah, we might sort of help a little bit, but once bitten, twice shy." The schoolyard bully analogy. Actually, you go back to Modi of India, because Trump tried to bully him about processing Russian oil. He said, right, 50% tariffs on India. So what did Modi do? He said he just refused to reply. And apparently Trump tried to phone him 4 times and Modi refused to pick up. And the next week he was over in Beijing or, in China for the SCO meeting. It was not Beijing, it was another of their many cities. Hugging and kissing with Xi and Putin. I mean, you couldn't have a clearer statement from India as to where they reckon their interests lie. I mean, India certainly exports quite a lot to America, but they weren't going to be bullied, and nor is Xi. And bear in mind also that they basically want to get rid of the dollar. Do they want to do more trade? More trade means they've got to have more dollars. No, they don't want that at all. And the latest thing I've heard, which is a fascinating twist on this, is that China has been buying British gilts. These are the government bonds. Why, we ask ourselves? Well, the answer is they don't want to buy any US bonds. They want to sell their dollars and buy something else. They can't. There's no gold left. They can't get any more gold. So what do they do? I mean, they buy even rubbish British bonds, which are absolute rubbish in preference to US treasuries. I mean, this situation is amazing. I think is the only thing I can say. I think also China's probably keeping the EU afloat too, buying German bonds or French oats or whatever, whatever they buy. Actually, I think the only one they can really buy, which makes any sense at all, is the Italian debt, because the Italians are actually making a pretty good job of turning their economy around and reducing the debt to GDP. I mean, it's fallen very, very substantially. It's still 145%, but I mean, that's down from something like 160, 170. So, they're actually, putting in sort of decent economic policies, but the rest of Europe is just a mess. I mean, it really is. It's horrendous.
So China won't buy our debt, and then they won't buy our soybeans. And so, I was thinking about
you can have this.
Okay. So thinking about rare earths, so many of these equities tied to rare earths have been just skyrocketing. They've just been shooting off like bottle rockets. And do you see this being like something that's going to continue with this? Because the rare earth narrative is very geopolitical, has a lot to do with like military defense, which is a huge thing when it comes to these nation security and everything. And right now you have a lot of strategic partnerships being developed. I think J.P. Morgan came out and wanted to invest, billions of dollars into the critical minerals for, our national interest and such. And so it seems like this story isn't over.
Yeah, no, I agree with you. I mean, I think as far as China is concerned, it's probably over. I mean, they don't want to part with any of it. And, what interests us is I think that the tight-fistedness when it comes to rare earths also extends to silver. We know it extends to gold. I mean, China, I keep on saying China is like Hotel California as far as gold is concerned. You go in, but you don't come out. So, but I think it's now the case with silver. I don't think we're getting any supplies. And, of course, ETF demand is just taking off. I mean, talking to various people. I mean, I had one podcast cancelled this week because they were too busy to do it. I mean, this is a bullion dealer who's absolutely swamped with buy orders, both gold and silver, and that's in one country, Australia. I also hear the same from my contacts in Switzerland. And I also hear the same from my contacts in America and also in the UK. I mean, everywhere, suddenly, everybody is beginning to buy. I mean, talking about retail market, is beginning to buy, coin small bars. And everybody's sold out. Yeah. Do you think under these circumstances that the price of silver is going to come back? Do you think that China is going to suddenly say, oh, well, we'll help you out. We'll let you have a bit of stock? I mean, no. Big backwardations in silver and lease rates soaring. I mean, I heard one report that it was 90% or something. I mean, this is desperate. This is desperation. The shorts are desperate. And, of course, the other thing they do, which continues to fuel the price, is they borrow ETF shares and sell them to get the underlying metal and deliver it, if you like, in accordance with their obligations. But the problem is they're then short. They have got to reverse the trade. So they haven't actually got themselves squared. It's rather like a payday loan. They've bailed themselves out for only days, literally. This is, And wow. I mean, quite experienced hands say that they've never seen anything like this. I mean, not even the bunker hunt. Sort of 40 years ago, it was quite so difficult as this. I mean, the bunker hunts they were sorted out by a mixture of COMEX changing the rules, and I think that also the other thing is that they were going to get Arab backing. They were promised Arab backing. And the Arabs were persuaded not to play. So, their scheme fell apart, trying to corner the silver market. But there's not one person, just trying to corner the market. This is everybody realizing that silver is way underpriced. I mean, you have a gold-silver, I'm looking at my screen now, a gold-silver ratio of 79.98. It should be somewhere between 20 and 30, which means that silver is mispriced. And what's triggered it, obviously, is the rise in the price of gold. It's really sort of brought forward the cheapness. And of course, people who sold gold earlier on aren't going to go and pay $4,000. They're going to go and buy silver because they think it's the cheap way in. It is the cheap way in. Yeah, it makes an awful lot of sense. But they don't have the the problem of having sold gold, let us say at $2,500 to only to get over the emotional hump of trying to buy it back at 4,000, 4,100, 4,200, whatever. It's far easier to say, okay, forget gold, we'll go and buy silver. And that's what they're doing. I mean, and bear in mind also that if you look at global portfolios, their exposure to physical gold is less than 0.5%. And yet you have got people like Goldman Sachs and Bank of America and all the rest of it. Their strategists are now saying buy gold. And I think Morgan Stanley even turned around and said you should have 20% of your portfolio in gold. I think by that they mean in gold and gold-related investments, to be fair. What have the portfolio managers got? I mean, you look at these banks have got over $1 trillion of funds under management each. What do the poor investment managers do? They haven't got any of this stuff yet. The big high honcho in the head office is saying buy gold. His ultra high net worth individuals, $100 million each minimum, turning around and saying, you're recommending gold. I haven't got any. Why haven't you bought some for me? So you can see that we're into the realms of peer pressure here. And this isn't something that's going to stop, if you like, because, I was reading, one of my Substack followers very kindly sent me a note from one of our papers, quoting experts saying, this run is getting mature and it's getting very volatile and it's generally a sign of a top. I mean, come on. They haven't a clue what's going on. They don't understand the dynamics of it. So it's a fascinating thing. I mean, normally these problems are resolved by a rise in price. But the problem is, the more the price rises, the more people buy the stuff and the less stock there is around. I think there's a term for it, this sort of thing where a higher price, restricts supply even more and creates demand. I think it's a Giffen good or something. That's what we've got here. I don't know about you, Darrell, but I'm finding, having sort of promoted the idea that, gold is a safe haven away from collapsing credit, I'm finding more and more people are now talking in that vein, which pleases me because people are beginning to understand why they should protect themselves. But it is interesting that I think we're just in the beginning of this. I really do.
The copper market, of course, is the biggest metal market on the planet, 200 to 300 billion globally of metal traded. Following majors around and picking up projects that they jettison can lead to great success in this business. Vizsla Copper, we're the team that brought you successes including ISO Energy and Vizsla Silver. If you want to learn more, you can find us at vizslacopper.com.
Going back to silver just a little bit, obviously, in the 80s, we had the Hunt brothers and cornering the market and such. Silver hit 50, didn't hit that in 2011. And then now we've surpassed that, and the gold to silver ratio is still pretty high. Where do you project silver could go from here? So obviously, this is an opportunity for folks.
I never give price projections. But bear in mind, Darrell, that what we're talking about is a collapse in the purchasing power of currencies.
Yep.
We're coming to the end of the fiat currency era, which started proper in August 1971. Now, the fiat currencies never last all that long. They can last 5 decades, perhaps 6 decades at the outset, sort of idea. They're always destroyed by the accumulation of debt. And that's what we have now. We've got this accumulation of debt. So what I'm saying is that it's the currencies going down rather than, it's not a pure argument, rather than gold and silver rising. Gold and silver are rising because of a squeeze at the moment, but most of the price relationship is actually from a falling purchasing power of fiat currencies led by the dollar.
Yep.
So that is going to continue. Now, we can see that if this is truly the end of the fiat currency era and system, then either they've got to reattach themselves to gold in order to protect the purchasing power of the fiat currency. It's got to turn itself into a gold substitute, if you like. Mm-hmm. Or it goes down to zero. And we're not going to get the sort of conditions without the discipline of gold, whereby governments will turn round and actually reduce their overall indebtedness. We're not going to get that. We're not going to see that. So, in effect, what we're on the way, unless we hear otherwise, for gold and silver to go infinite, because it's not gold and silver rising, it's the collapse of the currencies. I mean, the one of the best recorded instance of a currency collapse, of course, was the German hyperinflation following the First World War. And there were three phases of that. The first phase was after the war, while the economy stabilized and there was an increase in the quantity of Reichsmarks in circulation, which undermined its purchasing power. That was a 2-year event. Now, that actually fits in quite well with the post-COVID time, when we saw suddenly that the rate of inflation rose and it took bond yields up. Then we've now we're in the sort of tail end of a 2-year stability, if you like, really from late 2022 to the current day. Now, in Germany, they had exactly the same thing. Because what happened was that once things had sort of stabilized, okay, the currency had lost a lot of purchasing power. Like it lost, it was something like its purchasing power had gone down to about a fifth of what it was, during the war. Which again, it fell during the war as well. But once that stabilized, the currency stabilized, and credit, the expansion of credit, was redirected into supporting financial assets, particularly the stock market. So you had the situation where the Deutschmark, between really in sort of mid to late 1920, actually rose against the gold-backed dollar. It was the strongest currency in the world for that brief moment. The stock market took off. The stock market went up something like 300% until it began to crash in December. I think December the 1st, 1921, it began to slide. And then we were in the third period, the third phase. Now, we haven't got to the third phase yet, but it was the third phase that completely destroyed the currency, and the currency collapsed so that the ratio between gold marks, one gold mark, and the Reichsmark was there was 1 trillion to 1. That was what happened. See, 1 trillion to 1. We can put it in dollar terms too, because before the war, 1 mark was 23 cents. After the war, the Reichsmark, you had 4 trillion to $1. You could buy a house. You could buy a house in Berlin for $100. 6 bedrooms and all the rest of it. That's what happened. Now, we are set on that course. Now, I don't know how long it's going to take, and I don't know whether at some stage our politicians are going to be sensible enough to say, hold on a minute, we've got to change our thinking here. We've got to address this. We have got to secure the value of our currencies. And it doesn't matter what the cost is, because the cost of losing our currencies is far greater. Are we going to see that? We'll see. I can't see it at the moment. I think the sensible thing to do is hope it happens, but don't bet on hope.
Yeah, for sure. That's a very important point, especially, as I navigate, my investment journey, and as well as my preserving my purchasing power and protecting my wealth. I continue to buy, regardless of what the price is measured in dollars. I mean, obviously the dollar's falling against the metals, and ultimately it's money, so it's like, okay, as I continue to bring dollars in, I exchange dollars out for the metal. And so that's an important point. So just thinking about the drivers for gold. I mean, obviously we've had some significant, central banks buying and such. I mean, that's been like, the story for a while. Now we have like a chaos. I mean, there's concerns about, global relations. I guess right now we have some form of peace in the Middle East, but then in the whole Ukraine-Russia situation, allegedly, we're giving them Ukraine Tomahawk missiles and such, and that kind of put some more fuel on that fire. And so, it seems like there's still some geopolitical issues that we should be concerned about, and people are flocking to gold for multiple reasons. I mean, some people may be flocking to gold because of like the price, but some folks are like, hey, we have no stability in terms of tariff policy. We don't know what's happening there. It's one way and it's another way the next. Central banks are buying, and such. And so it seemed like people are grasping on to like things that you've taught for a while, that, hey, these currencies are going to zero. And I'd be interested in kind of just your perspective, because I recently saw a chart with the recent sell-off around the whole tariff dispute and the rare earth dispute, and the dollar sold off in that. And typically, when you think about, the past decade, like people flock to the dollar for safety. And so obviously in that scenario, people sold the dollar and got out of it. And so I suspect that's going to be a continued trend moving forward. Would you say?
Yeah, I mean, that's a very good point. The dollar and U.S. Treasuries were the safest place. You get worried about the future, that's where you go. But that's changed. It really has changed. And I think there is now a wider acceptance that, gold, after all, despite all the all the propaganda from the U.S. Treasury over the last 40 years that it's a pet rock and no longer part of the monetary system and all the rest of it. I mean, the fact of the matter is that in all our common law, gold is money. It is final settlement. Credit is not final settlement. And that distinction, as I say, goes back into Roman law. And Roman law basically it covered the entire Christian world, both the West and Eastern empires, and every nation which had Christianity, from Russia all the way as far as you can imagine across Russia to Portugal. I mean, we colonized the world for better or for worse, and we took our common law with us. China, meanwhile, had already come to the same conclusion. Bear in mind that Confucius was around about 50 years before the first Roman law, setting out the relationship between final settlement and deferred settlement, obligations and so on. That was the 12 tables in 448 BC. China had come to the same sort of conclusion, about money and credit and so on and so forth. And they invented paper money, which they called flying money, whereas the Romans invented banking. We've now got both. Flying money, basically. I mean, flying money started off as, if you like, a sort of representing gold, silver, precious items, whatever. It meant that merchants could trade over distances without having to carry physical gold bullion, silver bullion, whatever, to settle transactions. So it was extremely useful in that sense. But then, of course, the emperors got hold of it and used it for nefarious purposes, like for confiscating the underlying specie and just giving you bits of paper made out of mulberry leaves. I mean, but so governments haven't changed. This one's just the same. This lot are just the same. And it always comes to an end, and that's what we're beginning to see. And when fiat currency comes to an end, it's worth nothing. Absolutely nothing. You can plaster your wall with it. As I'm sure the Venezuelans and the Zimbabweans and even the Germans back in 1923 were doing.
Yeah, for sure. So just thinking about, I was watching Bitcoin and wanted to see how it reacted to, the recent news and such, and it sold off significantly. And I was thinking about, the history and the resilience of gold during like volatility and many of these, global tensions and such. And gold has always held its ground. And obviously, Bitcoin being, a newer asset, came out in 2008, 2009, and it hasn't been tested with these types of dynamics. And so, just seeing the price of Bitcoin just fall significantly, after that, it was pretty alarming and pretty telling for me.
Yeah. I mean, the point is that Bitcoin has no legal standing. Now, I know that all these Bitcoin fans say, well, the world is going to come to an end, paper currency is going to be absolutely worthless, and people will start using Bitcoin. I mean, it's a load of rubbish. It's got no legal standing. It's as simple as that. It will never, ever be used as settlement except between a few consenting adults who are sold on the whole concept of it. But I doubt even that, because, I mean, they're all so bullish. The point about it is that everybody is invested in it on the basis that they're going to sell it for huge numbers of dollars. This isn't the future currency. They expect to make millions of dollars. I mean, they look at the sort of relationship between 21 Bitcoins maximum and the size of M2 or whatever, and do their calculations to divide the latter by the former, and you get a price for Bitcoin. It's rubbish. It is not money. It is, if you look at what it correlates with the Magnificent Seven. It's the same cohort who are punting, momentum stocks as are punting Bitcoin. And when they collapse, Bitcoin will collapse with it. I mean, it is, if you like, it's like tulipomania, but without the bulbs. I mean, it is the purest form of speculation invented by man, except of course NFTs, but they've already died.
Yeah, for sure. Yeah, NFTs. I haven't even heard that acronym in a long time. So, yeah, I know some people lost a lot of money on that.
Yeah, people were paying tens of millions for, some digital image or something. I mean, it's ridiculous, completely ridiculous. But I suppose at the time they thought this was a very good idea. But I mean, we look back at it and think, God, suckers.
Definitely. So what's your perspective on the gold equities, gold and silver related equities at this point? I mean, many of them have significantly moved. Obviously, some people choose to, park some of their retirement in some of the gold equities and such. And, I'm an advocate of having physical, but I do own some gold stocks. And so just want to get your perspective on that sector in general.
Well, I have absolutely no doubt that their values will continue to rise, and in many cases rise considerably more quickly than metal itself. I mean, one of the nice things actually about the mining sector is that the price of oil has been held back compared with the value of gold and silver. So gold and silver mines, their margins are just improving in leaps and bounds. They really are. So that's very, very good news. The the thing that I would, there are two things I think I would caution. The one is that when the credit bubble bursts, taking equity markets down, people are going to lose a hell of a lot of money in mainstream investments in tech stocks, Bitcoin, whatever. So they're going to be selling down, the things they've made good profits in order to cover those losses. And that will include, to a large extent, I think, mining stocks. So that's the first thing I would caution. Be aware that that's very likely to happen. It's almost certain to happen. It doesn't necessarily destroy the sector. What it does mean is that, you get a marvelous run, and then, when things start crashing elsewhere, source of profit, they get sold off. And, if you know what you're doing in that sector, that's going to be a wonderful opportunity to pick up some very good cheap stock. So be aware of that. The second thing I would say is that all equities are credit. And when you get a collapse of credit, you have to navigate your way through that. What I think is particularly concerning is the DTCC system in America. Here we've got Euroclear, whereby you think you own shares in Newmont Mining or whatever it might be. No, you don't. It's the DTCC system that owns it. So what you have is you have the management of Newmont Mines has an obligation to deliver dividends and retain a share of your share, if you like, of profits within the company on your behalf. But it's not your behalf, it's on DTC's behalf. DTC has a matching obligation to you to provide precisely what they're being provided by the management of Newmont Mining. Okay, now let's assume we get a big meltdown. Melt up, melt down. What's the difference? What then happens is that the exchanges can use the, if you like, those Newmont Mining shares as collateral without your knowledge, because they're not yours. They're owed to you. And so long as they're owed to you, the DTCC can do what they bloody well want with them, knowing that they've eventually got to discharge their obligation to you. And if you sell them, then that obligation merely transfers to someone else. Welcome to the world of credit. Now, this is actually quite concerning because, we're going to see, I think it's becoming inevitable, a major collapse in the purchasing power of currencies, which is the highest form of credit in any economy. And you're going to have to think through very, very hard about your ownership of these mines through this process. And this is why by far the safest thing for you to do is to have physical metal in your possession or stored outside the banking system by an outfit that you have complete trust in. That's the whole point. ETFs, you've got exactly the same problem as a mine. You think you own an ETF share. No, you don't. Basically, it's owed to the DTCC unless you've decided that I'm going to get it in certificated form. Then your relationship is direct with the ETF provider, or if it's a mine with the mining company. But you've still got this obligation. They've got the obligation to deliver to you, a dividend stream as long as you own the shares and or accumulate value, if you like, on your behalf as a shareholder. So, this is the problem. It is a huge, huge problem. When you get the complete currency collapse, and navigating through this is going to be difficult. So, in summary, I would say initially you're going to make a lovely, lovely return out of a sensible portfolio of mining equities. But you've got those two hurdles to consider. The first is, will people start selling them down when they make huge losses, and they've got to cover those losses. Bearing in mind that positions in the US stock market are now fairly highly leveraged. I mean, if you look at margin lending on stocks, according to FINRA, that is now over $1 trillion. I mean, that's increased over the last 10 years from around about 250, 300 billion. So you've got some very, very large players there who borrowed large amounts of finance to finance stock positions. And those are going to get sold out. And so the people who are going to find that they're sold out will probably have to make up the shortfall by selling their mining stocks if they've got them. So that I think is the important thing. And the next thing is, and this is real Armageddon stuff, if you like, is what happens to your shares in the case of a complete meltdown. You don't actually own them. That's the point I'm making.
Yeah, that's definitely an important thing to consider, especially as investors and such. So I appreciate you sharing that. Well, Alasdair, appreciate the updates and just everything that you've shared with us today. A lot of value here in this discussion. And so where can people connect with more of your content, and, what are you up to?
Yeah. Well, I run my own Substack. I'm doing that now almost entirely. And it's McLeodfinance.com. That will take you to me. And it's getting lots and lots of subscribers, I'm very pleased to say. But if you actually want, the full information, then you become a paid subscriber. The monthly cost is probably a little more than Starbucks coffee.
Yeah,
which I don't think is going to break anyone's bank. For a year it's $100 or your currency equivalent. And I just hope that by educating people about really what's going on, not what you're told in the press, but really understanding what's going on, that it'll add enormous value to you, that sort of subscription. Yeah,
for sure. Well, you all heard it from Alasdair himself, so be sure to go check out Alasdair's Substack to get more information. We'd love to have your subscription to VRIC Media, so please hit the subscribe button. You all also click the link that's pinned in the comments to check out the New Orleans Investment Conference. So thank you, Alasdair, for coming on the show, and look forward to our next discussion.
It's my pleasure. Thank you for having me.